Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Planet Labs Pbc annual report. Planet Labs Pbc offers a wide range of businesses and services that cater to various industries and needs. The company's primary focus is on providing high-cadence geospatial data through its constellation of satellites. These include SuperDove satellites, which aim to image the Earth every day at a resolution of up to 3.5 meters, and SkySat and Pelican satellites, which capture images of specified locations several times per day with a resolution of up to 50 centimeters. In addition to these satellite services, Planet Labs Pbc also offers hyperspectral imaging through its Tanager satellite, which delivers full-spectrum imagery across the visible and shortwave infrared regions. The company's Earth observation platform enables customers to access, analyze, and act on its proprietary data catalog, providing insights through custom-built solutions or GIS workflows. Planet Labs Pbc provides a range of services, including designing and manufacturing customer-owned satellites, mission systems engineering, launch procurement, ground station infrastructure, satellite operations, and maintenance. The company also offers dedicated image tasking capacity on both company-owned and customer-owned satellites. Its clients include agriculture, mapping, energy, forestry, finance, and insurance companies, as well as government agencies. Overall, Planet Labs PBCS services are designed to meet the diverse needs of its customers, from providing high-resolution images to enabling data analysis and insights through its Earth observation platform. Planet Labs Pbc maintains a market capitalization of $12 billion, broadly in line with the industry peer group. Planet Labs Pbc trades at a higher price-to-book ratio of 62.94 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 30% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be categorized into several key areas. Firstly, revenue from existing contracts plays a significant role, including recognition of revenue from imagery licensing arrangements, dedicated capacity services, data solutions, professional services, and other value-added activities. Additionally, variable consideration estimated at contract inception can impact revenue growth or decline. Changes in market conditions, such as pricing practices, customer demographics, and volume of transactions, also influence revenue growth or decline. Furthermore, the number and quality of customer relationships and contracts drive revenue growth or decline. Advance payments from customers, including current or non-current deferred revenue, can also impact revenue growth or decline. Company-specific drivers such as North America, NAM, revenue, defense and intelligence customer-type revenue, Asia-Pacific and Japan, APJ revenue, and commercial customer-type revenue demonstrate varying trends of growth and decline. Other drivers, including cost of revenue, research and development, sales and marketing expenses, also contribute to the overall revenue picture. Tax-related drivers, such as net operating loss carryforwards and tax credit carryforwards, can have a significant impact on revenue growth or decline. Finally, other drivers, including capitalized research expenses and property and equipment, round out the key factors influencing revenue growth or decline. The net income of the company underwent significant fluctuations between 2024 and 2026. Initially, it decreased by $17.3 million from 2024 to 2025, followed by a more substantial decline of $123.2 million from 2025 to 2026. However, there was an increase of $31.4 million in net income during another unspecified period. The profit margins also experienced changes, with various factors contributing to their decline. The gross margin decreased by 1% from 2025 to 2026, while the non-GAAP gross margin also saw a similar decrease. On the other hand, adjusted EBITDA improved by $26.13 million during this period. The reasons behind these changes are multifaceted and complex. Decreased revenue due to lower demand for offerings was a significant factor, as were increased operating expenses and significant upfront costs associated with expanding into satellite services contracts. Additionally, the company's inability to accurately forecast contract costs, failure to complete contractual obligations, and loss of key personnel also contributed to the decline in net income and profit margins. Changes in pricing structures and competition further exacerbated these issues. The company's financial performance has been a subject of interest over the past few years. Initially, it experienced net losses and negative cash flows used in operations, indicating a challenging period for the business. However, there is a positive trend emerging. In 2026, the company generated significant operating cash flow, with a net cash provided by operating activities of $134,362,000. This indicates that the company has been able to manage its expenses and generate sufficient revenue to produce a positive cash flow from operations. The operating cash flow summary for 2026 further reinforces this point, showing a substantial increase in operating cash flow compared to previous years. The data suggests that the company's efforts have paid off, and it is now generating positive operating cash flow. This is a significant improvement over the past few years when the company experienced negative cash flows used in operations. The trend indicates that the company is on the right track and its financial performance is improving. The company's debt level has undergone significant changes over the past few years. In 2025, the total debt stood at $192,510, but by 2026, it had increased substantially to $957,255. This increase is largely attributed to the issuance of $460 million in convertible senior notes due 2030 on September 12, 2025. The company's interest expenses have also seen a substantial rise. In 2024, the interest expense was $0, but by 2025, it had increased to $832,000. This represents a significant jump of 308% from the previous year. Furthermore, in 2026, the interest expense rose to $3,436,000, marking an increase of 310% from 2025 and 305% from 2024. Overall, the company's debt level and interest expenses have experienced substantial growth over the past few years. The recent financial analysis reveals a mixed performance across various segments and regions. On the positive side, North America witnessed a significant revenue increase of 10.7% from 2025 to 2026. The defense and intelligence sector also experienced a substantial growth of 55.1% during the same period. However, some regions struggled with declining revenues. Asia-Pacific and Japan saw a notable decline of 41.4% in revenue from 2024 to 2025. Latin America's performance was relatively flat, with no significant change in revenue from 2024 to 2025. The United States and rest of world regions' performances are unclear due to the lack of detailed financial data. Management is optimistic about the company's outlook, driven by its mission to use space technology to benefit life on Earth. The company has evolved its strategy to deliver integrated downstream solutions, capturing a broader customer base and strengthening market leadership. To achieve this, management plans to invest in sales and marketing efforts to penetrate existing markets and expand into new ones. The growth strategy focuses on scaling in existing verticals, expanding into new applications, and making data more accessible to customers. While the company expects its capital expenditures and working capital requirements to increase, it believes that economies of scale will be achieved with increased subscription, revenue contracts, and analytic capabilities. Management is confident that the company's mission and strategy will drive growth and profitability in the future. However, specific guidance on next year's outlook or strategy is not provided. The company's focus remains on delivering integrated solutions, expanding its customer base, and strengthening market leadership to achieve long-term success. The company has a history of paying out dividends to its shareholders. This indicates that the company has generated sufficient profits and cash flow to distribute a portion of it to its investors in the form of dividends. On the other hand, there is no mention of share buybacks in the provided summaries. This suggests that the company may be focusing on reinvesting its earnings into the business or using them for other purposes rather than repurchasing shares from existing shareholders. Concerns have been raised regarding the potential for inventory buildup and supply chain disruptions. On page 17, a complex supply chain has been identified as a source of uncertainty, with risks including collision damage to launch vehicles and increased costs. Furthermore, the availability of launch vehicles is uncertain, exacerbating these concerns. Additionally, on page 98, it was noted that raw materials inventory has increased by $1,840, while finished goods inventory has become a new concern in 2026. These developments suggest that there are legitimate worries about the management of inventory and supply chain resilience. That concludes the financial summary for Planet Labs Pbc. Feel free to comment below, and I will be happy to answer them when possible.